shifting from how you acquire and connect with borrowers, talk to us about underwriting the brand and how critical is that for you today. And Eric, I'd like to kind of shift to you on that. At U.S. Bank, what are you guys doing to get a handle on the brand?
Yeah, I think we talked about the BCR yet, so I'm not sure if Daryl's on the phone.
Yeah, well, why don't you first share your views on what you're looking for the BCR to accomplish for you, and then we'll I think that's the perfect time to shift to Daryl. Thank you.
Right. It's meaningful to us, and being able to get data with regards to the historical performance of the brand, taking a look at rates of additions, deletions, and so forth, terminations, gives us a really good insight. But we really look at the underwriting of the brand is really twofold. It's first about taking a look at the numbers, and then working on developing relationships with the franchisors. So I think we were talking earlier about what can the brand do. That's where having a relationship with a brand and understanding how they operate and getting really good insights in terms of their philosophy on how they add franchisees and what happens if they have an open store and how they look at those types of things. That's what helps us out. So I would say that in a nutshell, it's meaningful. We do look at our customers. We're not the kind of shop that's going to qualify a concept and then just make loans subsequent regardless. We do look at our customers one at a time.
Okay, I appreciate that. So Daryl, I appreciate you joining with us today. Tell us what, give us the overview of the bank credit report as it relates to underwriting the brand.
Sure, Mike, and thanks for having me involved in this today. There's only one reason the bank credit report exists, and that is that a brand's performance history is a great indicator of future expected loan performance. Said another way, if I'm a banker and I look at a brand, I need to have some idea of what the likelihood is of me getting my money back on any loan, regardless of how well I underwrite the borrower. There's a performance history there, and that's what the bank credit report tries to uncover. It is not a recompilation of an FDD. It really looks at three main risk factors from a banking perspective. It looks at unit performance, it looks at system performance, and by the way, that's where a lot of banks look at SBA data, as flawed as that data is, but they use it as a proxy, and in some cases it works, in other cases it's a very poor proxy because of the quality of the data. And the third is looking at the franchisor's performance. Some of the things have been discussed on this call today about some of the things that franchisors do or might be expected to do from a lending standpoint to assist a lender either at the front end or the back end if a loan is either being put on the books or isn't working out according to terms. That's fundamentally what a bank credit report is trying to do on behalf of helping a lender get to an approved credit decision.
Great. And one of the things, I'll share this now, we're going to talk about it very briefly at the end. We're hosting a webinar to discuss the bank credit report in detail. So for those of you who aren't familiar with it, it's sponsored by the franchise brand. They're going to make the investment to go ahead and get Brand Data to do an independent analysis of the brand, and we'll be talking about that on March 1st. It'll be our next webinar. So thanks, Daryl, and continue to chime in as this conversation goes. I want to continue on this view of underwriting the brand, what else we're considering. Kevin, do you guys have specific policies at Atlantic Coast that you first start with to understand the brand?
Absolutely. First and foremost, we are funding these deals for the most part via 7A and SBA 504 loans. So, we are only considering those that are on the registry. Brands that do meet acceptable standards but are not on the registry, they could be subject to review and approval, of their FDD and bank counsel to determine their eligibility. Now, in terms of importance, I'm going to kind of split this into two. From a startup standpoint, our brand and franchise underwriting is crucial. Brands that we considered, that we will consider for startup financing, we rate using an internal scorecard, and it's based on a certain minimum criteria and parameters. Now switching gears on a business acquisition of a franchise business already in operation, we're going to. It's of very little importance.
Okay, good. Thanks. And as far as the a tangible charge-off failure rate number from the SBA side, can you share some thoughts you have there?
Yeah, currently, we are looking to have a charge-off and failure rate of no more than 5% and 7%, respectively. And certainly, I will say that there are exceptions made on a fairly regular basis. For example, I've got a deal that I'm a franchise startup restaurant deal here in Florida that I'm working on right now, where the failure rate was far exceeded, our guidelines. I had a strong borrower, but what really got us comfortable was I was able to talk to the CEO personally on the phone. We had a 30-minute conversation, and the explanations and were very, it was very quantifiable and very easy for us to understand, and we are now able to work on that deal. So, we obviously use our scorecard and the 5% and 7% as a screening tool, and that's where we like most of ours to fall. But there are a number of instances where we have made exceptions because there's obviously there is a lot of flawed information in those numbers. So, and we understand that.
So on that flawed information piece, Daryl, share with the audience as far as what the SBA and in support with Fran Data are doing to go ahead and get a handle on this data issue.
Okay. The issue that exists is twofold with regard to using SBA data, which is largely inaccurate for many franchise brands, and whenever that information is provided by the SBA, it comes out with a caveat at the very beginning, say do not rely on this credit decision. The reason they say that is twofold. One is improper lender reporting. Lenders are not required to report on every franchise loan that they have that it is a franchise loan associated with a particular brand. And because of the lack of enforcement of that, it often is underreported, the amount of activity that's done. And if it's underreported on the amount that the activity for a particular brand that's done, it does get corrected if the loan goes bad. So the bad loans are almost always acknowledged. The good loans aren't always acknowledged, which obviously distorts the percentages. Having said that, the other issue is keeping a current list of all of the franchise brands that are out there. Fran Data tracks usually in the neighborhood of 200 to 300 new franchise brands per year. And so a lender that is trying to report accurately may not even have the ability to pull down an accurate listing of all of the brands so that they can identify it. To that end, Fran Data is working with the SBA, and at the end of this month will put in a required new coding system for all SBA loans that will be effective, I believe, January 30th. And it's called FRUNS, Fran Data's unique numbering system, and it's associated with every brand. So on an ongoing basis, it will be constantly updated, and that part of the issue of inaccuracy of data will get corrected for every SBA loan. It has broader implications because every franchise brand in the United States that Fran Data can assess and validate will be given a unique number, and that will allow lenders to track both SBA and non-SBA lending in their portfolios in an accurate and consistent way. So this is coming out at the end of this month.
I appreciate it, Daryl. So you SBA lenders on the line, although it may make you angry that you now have to provide more information, hopefully we'll all get the benefit from it in better information. So thanks, Daryl. I want to kind of stay on this because obviously underwriting the brand is so critical. I'm also mindful of time, so we're going to work through a few additional points. The panelists have agreed to stay on a little bit longer to handle questions, so we're going to keep going on this content. We're going to expect to get to a Q&A probably just before the hour, maybe a little bit before, get some Q&A out there to get to your questions that haven't been addressed. I've been trying to work them in, so we're going to keep going now. Those of you who can't stay on past the hour, We will be recording this, and that Q&A session will be recorded as well. Doug, I know that you guys do a lot to underwrite the brands and make sure you're comfortable with them. We heard about the bank credit report as a tool. We heard about SBA default data. What else are you looking at to get a handle on the risk of the brand?
Well, for us, it is very critical because we do not have the SBA guarantee, so it's imperative that we get the other parts right, that there's historic cash flow, that we're comfortable with the borrower, and that we're comfortable with the brand. And in getting comfortable with the brand, I guess it all really starts for us with the franchise disclosure document, a lot of the information that's in there with focus on a great many things, but not the least of which is the exit rates there. And we've always put a lot more emphasis on the exit rates that are listed in the franchise disclosure document versus the SBA, because it's also a little bit of apples and oranges for us when you consider that a lot of the 7A loans that occur more often or not are for, if not first-time franchisees, second-unit franchisees, and not really our borrowers per se. But having said all that, we look hard at the FDD. Then we do look at the bank credit report if it's available for the franchise concept. It's extremely helpful when it is. And then lastly, it's really about the relationship with the franchise company itself and our ability to talk with them, to dig down a little deeper on things like site selection and on things like what sort of support is available in a worst-case scenario. And we look for a partnership and for a long-term relationship, and that's our ultimate goal.
Great, I appreciate that. So, and that, obviously, Doug, you're investing the time and resources to spend time with the brand. I know I met with one of your colleagues when we joined the Dunkin' Donuts lender session where they hosted 50 lenders at their Massachusetts headquarters to share the story, but not every community bank can go to that. So I'll shift you back to you, Kevin. You picked up the phone and called that CEO. How do you get in touch with the brand? How do you get information on the brand in a way that allows you to make better decisions?
Yeah, look, when we're doing our scorecard and we're trying to qualify those franchises, for us to be able to finance them, I would say that my two go-to platforms would be Franda and Daryl's team, and they're fantastic. They're very responsive, and it's been a pleasure working with that group. And I also utilize the BoeFly platform, the Intelligence Center. There's a franchise section with documents that I'm often able to pull down and review. So between those are typically my kind of go-to platforms.
Right. And I'll just add a little color. For, when a franchisee of a franchisor or member of BoeFly posts information, the brand's information is securely presented to the lender. The franchisee won't see it out of disclosure concerns, but the brand is able to share information securely with lenders, so guys like Kevin can get at it. Thanks, Kevin. Christy, I want to just get another thought from you on the number of units that you're looking to do. If a brand were interested in connecting with you guys and they have a limited amount open, do you have a sense of where that hurdle is going to be as far as how many open units you guys are going to be looking for within your group?
We're actually establishing our guardrails or our criteria with those specific brands. Again, we're focusing on a specific industry or specific sector, but we're also looking at a minimum 50 number of units within that franchise, as well as years established. We're looking at, right now we've gone back and forth between like the 5 to 10 years, but we're going to have an established number of years out there as well.